Hey everyone, welcome back to Corporate Decoder. Today we're diving into the annual report of a company that brings a whole new meaning to the term fighting chance. And while the name might make you chuckle, the financial realities are no laughing matter. We're looking at Lingerie Fighting Championships, Inc.'s Form 10K for the year ended December 31, 2024. Yes, it's exactly what it sounds like, a sports entertainment league featuring women wrestling and doing mixed martial arts in lingerie. Let's see what the numbers have to say about this unusual business model. First, a quick history lesson. The company started as something completely different, dealing with oil and gas services in Southeast Asia. That didn't work out, so in 2015, they did a reverse merger with Lingerie Fighting Championships and changed their name to match. They've been trying to build this brand ever since. A big part of their strategy is getting views on YouTube with over 800,000 subscribers and 250 million views to date. They focus on live events, video programming for digital and home video, and even pay-per-view programming. They also sell merchandise like DVDs, t-shirts, and calendars on their website and through other online retailers. The competition they face includes World Wrestling Entertainment, WW, and Ultimate Fighting Championship, UFC, both giants with way more money and established fan bases. They also compete with other forms of media for viewers' time and attention, things like cable TV, streaming services, and video games. It's interesting that even a company of this size has to think about cybersecurity, explaining they have procedures in place to manage those risks and haven't had any material cybersecurity incidents as of the end of 2024. Now let's jump to the financials. For the year ended December 31, 2024, revenue was about $133,000 compared to around $118,000 in 2023. That's a small increase, but cost of services also went up. Gross profit is practically the same in both years. Operating expenses have jumped significantly, while other expenses have swung dramatically from income to an even greater expense, leaving a net loss of nearly $1.9 million greater expense, leaving a net loss of nearly $1.9 even dollars, a big fall, compared to a net income of $308,000 the previous year. In short, the numbers reveal a company struggling to turn its unique brand into real profit. Looking at the balance sheets at the end of 2024, they had very little cash, just about $2,200, but massive current liabilities around $5.9 million less. This results in a working capital deficiency of over $5.9 million. To survive, the company will need more financing through sale of shares, which might not be sufficient for capital demands. This is why the auditors have flagged substantial doubt that the company can continue to operate. Their cash flow statement shows that operating activities are consistently negative. They're burning cash, not generating it from their core business. They explain their accounting for things like convertible notes, which are basically loans that can turn into stock, and warrants, which are options to buy stock. These can be tricky because they often have features that are considered derivatives, requiring the company to estimate their value and potentially record gains or losses based on market changes. These changes in value of derivatives can significantly impact the reported earnings, and that's exactly what's happening here. Turning to shareholder equity, the company has authorized quite a lot of preferred stock and common stock. 51 shares of Series A preferred stock have been issued to Sean Donnelly, the CEO, giving him a lot of voting power. As a subsequent event, they described releasing their most recent event. Now, let's get to my overall take on Lingerie Fighting Championships. The company has a very long way to go before they can even consider themselves a stable organization. The financials are alarming, showing a clear inability to generate positive cash flow or net income. It's hard to see a clear direction in spite of growing YouTube views because of the failure to monetize the audience. The notes that are convertible to stock all seem to be in default. And the board and CEO has issued themselves tons of warrants, making their share price a race to zero if they need to dilute it to pay off any debts. Even if the company managed to become successful, it would likely come at the expense of public investors. In notes that are convertible to stock all seem to be in default, and the board and CEO has issued themselves tons of warrants, making their share price a race to zero if they need to dilute it to pay off any debts. Even if the company managed to become successful, it would likely come at the expense of public investors. Thanks for tuning in to Corporate Decoder. Don't forget to hit that like button, drop a comment, and subscribe for more deep dives into the financial underbelly of publicly traded companies. See you next time.